If you look at investment growth in the trade-dependent economies of Asia-Pacific, particularly Korea, Malaysia, economies like that, we're seeing investment growth at a 7-year low now in the first quarter of this year. So clearly trade tensions are having an effect. And that's also true in China, where manufacturing investment growth is at a 15-year low.
Surely when you look at the currency, though, that may be having an impact. I mean, the Chinese currency has fallen about 10% against the US dollar in the last 12 months or so. Has that offset the impact of tariffs on Chinese imports in any way?
Yes. Actually, the exchange rate depreciation is a really effective way for China to offset the impact of tariffs. And I think it's been a pretty smart move by the Chinese to let the currency show a little bit more flexibility versus the dollar. And that 10% move has proven, I think, quite effective in helping to support growth.
So more so than anything, would you say that US restrictions on knowledge exchanges with Chinese firms like Chinese technology manufacturers, for example, are actually having more of an impact than anything else?
Absolutely. So what we would say that this is much more about technology than it is about trade, and tariffs are only part of the story. So these investment restrictions, export controls, measures that will slow the rate of technology transfer to China are actually more important than tariffs.
Sean, would you say that trade tensions are one of the big reasons why the US central bank perhaps is looking at cutting interest rates this month? I mean, by all accounts, you look at a lot of the data and it seems to still be fairly strong. I just wonder whether a rate cut is actually justified in this kind of environment. What are your thoughts on the impact of trade tensions and how the US Fed is looking at it?
Well, that's certainly what the Fed is telling us. So if we look at the recent remarks from Jay Powell, they're very much related to international uncertainty. When we look at the domestic economy, we would agree that, in fact, things look pretty good. Domestic consumption growth is holding up. The labour market looks tight. Although investment growth is slowing at the margin, it still remains fairly robust. So it does seem to be the international environment that is driving the Fed decision at the moment.
Do you think we'll see a rate cut by the end of this month?
So we think that we will see one rate cut this year as an insurance policy against a slowdown. It looks likely that that might now happen in July, and we'll have to wait and see how the data develop to see whether they'll actually do any more this year.
It almost seems like Donald Trump is bullying the Fed into cutting interest rates sort of sooner rather than later, almost to cushion the damage that he's causing by these trade battles and the tensions that are arising between the US and China. Do you think in some ways the Fed is bowing to White House pressure?
No, I think that the Fed is being very careful to defend its independence and explain to the market clearly why it's taking the decisions that it's taking. And the other thing I think to bear in mind is that the market itself was telling us that they were quite worried about the growth outlook. And I think the Fed is taking that into account in its decisions as well. I think you have to understand what the market's pricing in, and the market was suggesting that perhaps a rate cut was going to be helpful to stabilize the growth outlook for the United States.
And how do you see our prospects domestically? Do you think Australia's in for some troubling times ahead?
Well, certainly the external environment is going to get more complicated for every country, including Australia. For now, if you look at Australia's export growth, it remains fairly resilient. So the exposures that Australia have suggest that the country is coping reasonably well. But overall, if you look at what's going on in the economy, growth has slowed. Of course, the housing market is a drag. That's weighing on consumption. Investment growth has also been a touch weak. So it certainly makes sense to see policy easing at this point.
Well, it really does seem like the RBA is doing everything it can to try and stimulate growth, doesn't it? I mean, we've seen 2 interest rate cuts in recent times, down to a record low of 1%. Do you think that will be enough?
Well, certainly I think if you look at employment growth in Australia, it remains fairly robust. And if you look at inflation, that's certainly below target. So putting that together, the RBA easing probably should be enough to help stabilise growth expectations and provide some sort of lift as we go towards the tail end of this year. But I think the situation has changed in Australia as rates get close to zero, because when we think about what might happen in the event of a global shock that could cause growth to slow even more, there is limited room for the RBA to move further. So I think policymakers will have to think about what happens next. What's the plan B? What other options are there?
Well, that brings up a really good point, because you couple monetary policy, obviously, with fiscal policy, and you just wonder whether perhaps the government is doing enough. I mean, Treasurer Josh Frydenberg has been out saying that he's fairly confident on their infrastructure spend, $100 billion over the next decade or so. But you know, you just wonder whether they perhaps should be doing more, whether they should be getting out spending more in order to help out the monetary policy side of things as well.
I think it all depends on the evolution of the economy as we go through this year, as we go into 2020. But broadly, if the economy continues to slow, I think policymakers will have to think about the coordinated impact of monetary and fiscal policy. And as I said, monetary policy is running out of room as we get close to zero, and there may be scope for fiscal policy to do more, but much will depend on what the growth outlook is for 2020.
When interest rates are so low, I mean, the government can borrow cheaply, can't they? So you just wonder whether that is something they should be doing and therefore spending more.
Absolutely. I think that's true almost in many developed economies, whether it's Europe, the United States, and Australia and other parts of Asia Pacific. At the moment, governments can borrow very cheaply, and at the same time there are infrastructure and other social spending needs that could be met. So it may well be a good time for governments to think about a little bit more fiscal support.
You almost have mixed messaging, don't you? I mean, the RBA on the one hand seems to be saying, look, things are not looking so great. The fact that they are cutting interest rates, they need to sort of stimulate growth. Yet on the other hand, you have the Treasurer and you have the government saying everything's okay, don't worry, you know, things are looking fine at this point. Who do you believe? I mean, what is your opinion on perhaps who's right?
Well, I think we need to listen very carefully to what the RBA is saying. They are pointing to the fact that while employment growth is still fairly good, we might need a lower unemployment rate to generate the inflation to get us back to target. And that's a slightly different message from saying that growth is really weak and is getting worse. So the RBA is basically saying we just need more policy easing to generate the inflation that we need to get us back to 2%. And I think broadly those messages can be fairly consistent.
And do you think Australia is headed for a recession?
No, we don't think Australia is heading for a recession. We don't think that we're going to see a recession either in the US, Europe, or China. Policymakers are broadly responding to some of the signals of slower growth that we're seeing, and that should be enough to put a soft floor under growth, we think, this year globally, and provide us with an ongoing slowdown, but one that is fairly moderate as we go into 2020.